Welcome back, investors. Today, we're diving into the world of consumer defensive stocks, focusing on four major contenders in the discount and retail space: BJ's Wholesale Club Holdings, Dollar General Corporation, Dollar Tree, and Target Corporation. These companies showcase the diverse strategies and operational efficiencies driving the discount retail industry. Let's kick off by analyzing their price-to-earnings ratios, a cornerstone metric for understanding how much investors are willing to pay for each dollar of earnings. BJ's Wholesale Club leads with a trailing PE of 23.06, above its 5-year average of 18.33, suggesting market optimism or strong recent performance. Its forward PE of 22.89 points to expectations of continued stability. Dollar General, on the other hand, posts a trailing PE of 12.68, significantly below its 5-year average of 20.17. This may indicate recent earnings challenges or a discounted valuation by the market. Its forward PE of 12.95 suggests expectations of steady earnings ahead. Next, Dollar Tree exhibits a trailing PE of 12.15, also below its 5-year average of 20.00, reflecting potential concerns about growth or market underestimation. However, its forward PE of 11.56 hints at further undervaluation. Lastly, Target Corporation's trailing PE stands at 14.27, under its 5-year average of 19.05, and its forward PE of 14.58 indicates slightly optimistic earnings projections. Turning to the price/earnings to growth ratio, a key metric for valuing growth potential, BJ's stands at 4.53, signaling a premium on growth expectations. Dollar General's price/earnings to growth ratio of 9.98 suggests its growth is highly priced relative to its earnings. Dollar Tree, with a price/earnings to growth of 1.01, appears fairly valued relative to its growth potential, while Target's PG of 1.78 indicates a moderate premium. Insider ownership is an essential gauge of management's confidence in their company's future. BJ's has insider ownership of 0.9%, typical for a large corporation. Dollar General's 0.31% reflects limited insider stakes, while Dollar Tree's 0.11% indicates minimal insider alignment. Target Corporation's 0.24% shows similar trends of moderate insider involvement. Profitability metrics highlight each company's efficiency. BJ's delivers a strong return on equity of 35.79% and a return on assets of 7.94%, emphasizing efficient operations. Dollar General's return on equity is 19.37%, with a return on assets of 4.3%, reflecting moderate profitability. Dollar Tree posts a return on equity of 13.47% and a return on assets of 4.96%, showcasing consistent performance. Target impresses with a return on equity of 32.37% and a return on assets of 7.62%, indicating a strong balance between equity and asset efficiency. Return on invested capital provides further insights. BJ's ROIC of 18.42% signifies efficient capital use. Dollar General's ROIC of 8.27% reflects modest returns, while Dollar Tree's 9.56% and Target's 17.23% highlight efficient capital deployment in their respective operations. Let's discuss share evolution, a critical metric for shareholder value creation. Over the past decade, BJ's shares have increased at a compound annual growth rate of 4.52%, signaling expansion efforts. Dollar General has decreased shares at -3.60% compound annual growth rate, a shareholder-friendly approach. Dollar Tree's share count has remained flat, indicating stability, while Target's shares have decreased at -3.53% compound annual growth rate, showcasing commitment to shareholder returns. Continuing with earnings per share or EPS trends reveal future potential. BJ's current EPS is $4.23, with a projected 5.09% compound annual growth rate over the next 5 years. Dollar General's EPS of $6.07 is expected to grow at 1.27% compound annual growth rate. Dollar Tree's EPS of $5.77 is projected to grow at a robust 12% compound annual growth rate, and Target's EPS of $9.43 is forecasted to increase by 8% compound annual growth rate. Examining historical EPS growth over the past decade, BJ's leads with a remarkable 35.76% compound annual growth rate. Dollar General follows at 6.31% compound annual growth rate, Dollar Tree at 7.07% compound annual growth rate, and Target at 9.2% compound annual growth rate, all showcasing varying degrees of growth. Free cash flow per share is a crucial indicator of a company's ability to generate cash after capital expenditures. BJ's free cash flow per share has grown at 19.78% over the last decade and currently has a 2.8% free cash flow yield, while Dollar General achieved a more modest growth of 10.2%. His free cash flow yield is higher at 9.93%. Dollar Tree shows a modest 3.16% free cash flow growth and 5.72% free cash flow yield, so less growth and yield. Finally, Target delivers a solid 9.88% over the past decade with some upsides and downsides, however currently offers a spectacular free cash flow yield of 7.42%. For dividend-focused investors, these companies offer distinct yield profiles. BJ's does not currently pay a dividend, but assuming a 60% free cash flow payout ratio, it would yield 1.68% with quarterly payments of 41 cents. Dollar General offers a 3.07% yield with quarterly payouts of 59 cents, supported by an 11.58% compound annual growth rate in dividend growth over the last decade. Dollar Tree also does not pay a dividend, but with the same assumption, it would yield 3.48% with quarterly payments of 61 cents. Finally, Target provides a 3.33% yield with quarterly payouts of $1.12 and an 8.86% compound annual growth rate in dividend growth over the last decade. This is due to the lack of consistency in dividend growth, with some years of less than 35% growth and others with almost 20%. Operating and profit margins are critical indicators of efficiency. BJ's has an operating margin of 4.08% and a profit margin of 2.71%. Dollar General achieves margins of 4.98% and 3.33%, while Dollar Tree posts 5.49% and 3.92%, respectively. Target leads the group with an operating margin of 5.58% and a profit margin of 4.06%. These low margins are natural for this industry. However, it is to be taken into account that if something bad happens in the economy, this company can obtain losses very easily. As a result, these types of companies should be bought at reasonable prices. Looking at revenue and earnings growth over the past 8 years, BJ's demonstrates very positive evolution, outperforming the Staples ETF, XLP, in total returns over the last 5 years. Dollar General shows positive evolution, but this has not translated into outperformance against the XLP, and having a negative total return. Dollar Tree's growth has been more flat, reflected in underperformance compared to the XLP. Finally, Target displays positive growth but has similarly underperformed relative to the XLP. Debt levels are critical for assessing financial health. BJ's debt/EBITDA ratio of 2.81 and debt/free cash flow ratio of 8.28 suggests moderate leverage. This ratio is indicating that to pay all the debt would take almost 9 years. Dollar General's ratios of 6.15 and 10.77 indicate higher leverage, while Dollar Tree's 3.78 and 12.04 reflect a balance of debt and cash flow challenges. Target's low ratios of 2.18 and 4.29 underscore strong financial discipline. As you can see, all 4 companies are having problems with their free cash flow that is translated to high debt ratios. However, it is expected that in the near future the normal values will be recovered. Stock price performance over the last 52 weeks varies significantly. BJ's has delivered an impressive return of 45.26%, while Dollar General and Dollar Tree have faced declines of -40.97% and -46.28%, respectively. Target has seen a slight dip of -2.79%. Market caps reveal their size and scale. BJ's stands at $12.88 billion, Dollar General at $16.92 billion, Dollar Tree at $15.07 billion, and Target leads with $61.65 billion. Finally, let's examine analyst expectations and fair values. Analysts have set BJ's price target at $97.10, representing a downside of 0.45% from its current $97.54. My fair value estimate of $66.98 suggests overvaluation. Dollar General's price target of $90.01 represents an upside of 16.98% from $76.94, aligning closely with my fair value of $78.81, indicating slight undervaluation. But be cautious and remember all the metrics mentioned. Continuing, Dollar Tree's price target of $84.13 represents an upside of 20.03% from $70.09. My fair value of $93.95 highlights a huge undervaluation. Finally, Target's price target of $141.64 represents an upside of 5.29% from $134.52, while my fair value of $154.99 further supports undervaluation. Each of these companies presents unique opportunities and challenges. From BJ's impressive growth to Target's strong margins and shareholder returns, and from Dollar General's undervaluation to Dollar Tree's growth potential, there's something for every investor here. As always, align your investments with your goals and do your research. If you enjoyed this breakdown, don't forget to like, subscribe, and hit the notification bell for more insights into the financial markets. Until next time, happy investing!